Hi guys, welcome back to the channel. My name is Dave, and covered call funds certainly have exploded over the last few years. You can find a covered call fund that covers just about everything, from popular indexes like the S&P 500 to individual stocks and now even Bitcoin. You can also pick your poison when it comes to yield or income. When you look at these products, you can buy something like DIVO with a modest yield of 4.6%, or you can go with a yield max fund like CONY, which is based upon Coinbase and currently yields 131%. However, after reviewing many of these products, talking to the fund managers, and having experience trading options myself, it's time to let the cat out of the bag and talk about the hard truths and these products. And I might just shatter some dreams along the way. If that is what you're looking for, please stick around. Whoop. So let's run through some of what I think are the common misconceptions when it comes to covered call funds, because honestly, I hear lots of wild views when it comes to these types of funds. And hopefully, whether you currently own some of these or you're thinking about buying some of these, this will help you figure out if they are right for you. And just to be honest and transparent, I do own some of these myself. So I am pro covered call ETFs in a sense, if they make sense for you. And we will do true or false with these misconceptions so you can play along from home and decide if I'm an idiot or not.
No offense, but you are a stupid asshole.
So true or false, these are income products. Technically, yes, but only because they choose to make routine distributions. In my mind, no, they are not income products. One of the big fallacies with options is that as an option seller, you are generating income with a sold call. However, that is only half the transaction. You're actually taking in a credit that is also a liability on the books. It could go to zero, in which case you would keep the credit, but it could also go to a multiple of what you sold in the first place. For example, here's an option that I sold on iBit recently for about $1,396. It was looking great. Is that my income? No, because if I wanted to exit the option right now, it would cost me about $4,325 for an option loss of $2,929. That is quite different compared to an income producing bond with a consistent coupon. Most options are actually used for hedging. Think about buying a put on Nvidia when you own Nvidia shares. It's there to act as protection, right? As a full hedge. Or for speculation, think about buying a call or buying a put when you don't own Nvidia, but you have a directional signal that makes you believe the stock is going to move in one direction or the other. Since our example in this case is a covered call fund, a sold call is a hedge as much as it is a hope for income. In other words, when we sell a call, the outcome is one of two things. Either we are keeping a small amount of income when the stock stays below our sold strike, which hedges our position slightly, or capping our upside where the stock gain hopefully hedges our option loss. Either way, in a sense, these two working in tandem end up hedging our portfolio as much as providing income. And since we're on the topic of income, I have to mention it, the really high yielding products. You know the ones. True or false, yield matters. Nope, it doesn't. Ignore that eye candy. It pops up everywhere. You know, you can still buy these, but understand what you are buying. I will say that as volatility increases, I think hedging with options can make sense depending on what you're trying to accomplish. However, from just a pure options perspective, you get more initial option premium with more volatile products, but you still have to close that sold option, which may have just flown past the strike price because it is a more volatile product in the first place. And while some of these volatile products perform really well at times, it is often because the underlying is performing really well. The ETF CONY from YieldMax is a great example of this. It's currently yielding a whopping 131%, and it was doing a pretty good job of tracking Coinbase stock for most of the year. But recently it has fallen off as coin has taken off during the latest rally, and total return is now less than half of that of the underlying as of today. If still not convinced that yield is pretty meaningless, if YieldMax gave you a modified version of this stock, right, or this ETF, CONY, with an option strategy that gave you, yield of only, let's say, 20% instead of 131%, but it offered you a total return closer to that of coin right now, would you take that in this case? You absolutely should. You should. You will still have give and take with these products. So understand what you are buying, and you are not buying yield. That eye candy number, that yield, is not yours to keep. Plus, these tend to have a very high expense ratio. However, we continue to see it, right? Just like flies on poop, that yield brings in the buyers. True or false, covered call funds will underperform the underlying stock or ETF that they are based upon. This tends to be true. Not always, but it tends to be true. So if you're in a bull market cycle with a particular stock, you're best not to cap your upside. However, when the underlying is trading sideways, a covered call can outperform. A covered call does set a cap on the upside of whatever it is tracking, so we are playing a bit of a probability game. If we stay below the cap, or the sold strike price for the call, or even if it goes slightly above, we outperform during that cycle with a covered call version. If we go flying past it, we underperform. Simple math to compare the two is ETF performance, or stock, versus ETF performance plus sold call premium minus the cost to close that call. Whichever is greater wins for that period in time. And these funds have all different types of option strategies as well. So some are going to use short-dated options while others use long. So these types of variables will also have an effect on performance with different markets. But over the long run, we do tend to give up some performance with these funds. So why buy them? Well, that brings us to our next true or false. True or false, a covered call fund offers us protection against a significant drawdown. This is true, but maybe not as much as you would expect. This is a comparison of QQQ to QQQI, which is a covered call ETF from Neos that we've talked about in the past, and it is looking at performance here in 2025. We can see the max drawdown during the April period of this year when tariff talk sunk the market was lower for QQQI by a decent amount, and we also see that the beta was also lower. The strategy actually made the beta of a NASDAQ-based ETF slightly lower than the S&P 500, which is pretty cool. Like nerdy, cool, but still cool. So for those that don't know, beta, if you're not aware, is a measure of the volatility of a stock or ETF to a benchmark. So in this case, the benchmark is the S&P 500. So we are saying during this period, QQQ should move 1.32 times that of the S&P 500, while QQQI will move like the S&P 500. So to answer the original question, yes, they do offer some protection, but a nasty drawdown is still nasty. True or false, total return is all that matters. If these sacrifice total return, they make no sense. I think this can be both true and false. Yes, in the long run, total return wins out. Math is math. It's hard to argue with that. And for crazy high-yielding products, I think that's even more important. However, we have seen covered call ETFs go toe-to-toe with the underlying ETFs for periods of time and sometimes even outperforming them. So if we think we are close to total return with a covered call fund, and we have, for example, a tax benefit that offsets that difference, what is our best option as the investor? For example, let's say you want a cash flow in a taxable account. Covered call funds might be a good solution. So in 2024, my tax numbers for QQQI were 94% return of capital and 6% cap gains for an estimated effective tax rate of about 1% on the distributions I received. And I'll link this video above if you want to go watch this video. This essentially kicks my tax can down the road. I still have to pay it, but not while I'm earning a good income and still employed. Maybe I push it off till retirement. So if my choices were to either sell shares of QQQ that I purchased years ago, where I would pay 15 to 20% in long-term capital gains tax on my gains, or I get to receive monthly tax-efficient distributions from something like QQQI, what is best for me? I personally would kick the can. But I always add, you need to have a reason, for the income, or else look for total return. Another way I say this is, how much growth can you afford? If you don't need much, don't buy much of these covered call funds and simply invest in the underlying. In my opinion, cash isn't king. Cash flow is king. If you have enough cash flow, what can't you do? So with that in mind, who should consider a fund like this? If you understand the downfall, which is potential underperformance compared to the underlying, and don't underestimate that fact. It can be significant in some cases. Just look at this one, looking at 3-year performance of QQQ versus QYLD, which is getting destroyed by the option strategy. So that can happen, but we can combat that by buying some of the best funds. However, for this sacrifice, we do get some perks. So if you want to reduce the overall drawdown and beta of your portfolio, and if you have a need for the cash flow at this time and you can benefit from a tax perspective, you might consider some of these funds. But be choosy and pick the best. Look at total return and ignore that sexy yield eye candy. The world of covered call funds continues to evolve, and with all the new funds coming to market, this is creating competition, which is good for us. So these guys are out there scrambling about, trying to modify their option strategy to capture as much upside as they can and mirror the underlying as much as they can while providing tax-efficient income. All good for us buyers, and they're getting better and better at this. In the next video that I'm going to do, I'm going to be talking with Tap Alpha about TSPY and how they're modifying their strategy to hopefully capture more of the upside based upon what they learned during our V-shaped recovery here in early 2025. So they continue to evolve, and again, that's all good for us. So if you're looking for that type of information, like and subscribe. As I mentioned, I do own several covered call ETFs myself, and you can see what some of my favorites are in this video right here. If you have any questions on any of this, please ask down below, and we'll see you next time. Have a great night. Take care. Whoop.